Hello everyone, welcome to Fifth Investments, a place where we take our stock market profits and build income producing assets. If you are new to the channel or new to the stock market material, I will make sure we include a vocabulary sheet down below. That way you can be able to go and click on that and check things out. Now, looking at traders, we have the day trader and we have the swing trader. Defining the word trader. A trader is someone who buys and sells in a single day or a short period of time. Trading can be very risky. You play the wrong move, you can lose your money. If you are impatient, you can lose your money. If you don't understand risk management, you can also lose your money. If you're buying stocks because someone on the internet said buy it, then it dramatically drops, you will of course lose your money. So I hope you hear the main concept that I'm saying is if you don't know what you're doing and you're day trading or swing trading, you will lose money. Now, some of the differences between being a trader that trades equity versus a trader that trades options is that with equity, worst case scenario, you just move over those shares that you bought to trade over to the long-term portfolio, assuming that your trade was in a big cap stock and that your risk management was right on point, where you weren't putting too much into that play and you actually have more capital to continue trading. Now with options, you buy and you have a expiration date. When you have that expiration date, you have up to that certain amount of time for your trade to go right or wrong. So a lot of times people will try to hold until they see profit. Some people, they sell early if they have a stop loss. It really just depends. But regardless, it's all about risk management. It's a technique to it, and you come in there with a plan. To me, one of the biggest differences between being a trader and an investor is the commitment. You have to commit to the software, to staying up on news. You have to learn all of these technical concepts. You have to really focus on patience and discipline. Very quickly, I want to add in what I mean by having patience. I know most people hear the word patience and they say, oh yeah, okay, that's fine. We got to have patience. But I just want to let you know, I want to show you what I really mean about patient and being patient and waiting for a play to set up when you are a trader. This is not for the investors. This is for people who are watching this and want to really see the differences between the trader and the investor and what you are looking for. So I'm looking at Amazon. I'm going to go to a 20-day 1 hour. And I drew this circle here. I'll explain it to you in a minute. That's fine. It's a terrible circle. But okay, so when I say being patient, this here is November 5th, okay? If you were on this side, you made money. If you were on the call side, of course, because you can make money both ways in the stock market. So this way, great, you made your money. For the people who missed it, probably bought this dip here. We call it FOMO, which is fear of missing out. But you probably bought the dip here thinking that it was going to continue, not knowing that this 32.26 was a key resistance, right? So you bought this dip up. You probably got greedy and you kept holding, and little do you know, 2 days later, it's back at rock bottom. So, and I say that because you have new traders or you have people who aren't patient. After a stock goes from 29.83 all the way to 33.50, it needs some cooling off. So if you miss that play, you just have to understand that you just missed it, and that's it. You just sit back and you wait for another entry and you just wait. So that's something that I mean when I say being patient. And when I say, being patient and letting the play come to you, what I mean is, let's go to 180 day chart. Okay. So when I say this, letting the play come to you, if you go back to September, October, area. If you go back to the September, October area, you'll see that it was up at 35, 34, came down, touched 29, and this is considered an inverse heads and shoulders, where it kind of comes down and it's just a reverse of what it did. This is a setup play. Once it got to this area, we knew that this was probably an inverse and that it probably had momentum. So this is a great entry for this play. But this takes you being patient, meaning that During this time, this whole middle section here, you're just kind of sitting out and waiting and evaluating the play, which is a very, very long time. So if you are only trading Amazon, then you're sitting on the sidelines for a long time. So this is what I mean by being patient. You have to do your research, you have to study, and you just have to let the play develop. This is more of the trading, not the investing. And I forgot to mention, the reason why I have this oval here is that, as you see, after the inverse heads and shoulders, it kind of came down. This is where the being patient area is. It went up and went down, and now this is that consolidation area where you just have to be patient. Possibly a great buy-in area would be in this area. I'm not telling you this is where a person should be buying, because I know this is like more of a current chart, but all I am trying to get to is that traders have a certain technique and a certain lifestyle that they go by when it comes to the stock market. One of the biggest misconceptions that day traders and option traders get is that they barely have to do any work, and now they're making millions. And I'm here to tell you, like most people who've been in the business before, that's false. That's not how it works. All the work is done just on the back end. They put out the image of what they want people to see, whatever, if it's the cars, if it's the clothes, or whatever that it is, that's the image that they present. But what they don't show is the studying on Sundays, or let's say Saturday, Sunday, up until 11 o'clock at night, waking up at 4 in the morning before the market opens. And just to give you an example, there's been times where I will spend 3-4 hours on Sunday night gathering my plans or finding the stocks that I want to be in my watch list. And then you watch the market on Monday for 4 to 5 hours, see nothing, your targets didn't come in, and then you wait until Tuesday, you watch it for another 5-6 hours, still didn't come in, and right before market close, I'm able to enter the trade that I've been waiting for the longest. I enter it, and then now Wednesday is the time that I wake up and I see a big gap up, and I'm able to profit $700, $800, or whatever that it is. For some people it may be less, for others it may be more. But my whole spiel on that is that it takes work. People who day trade or swing trade have developed a specific skill, meaning that if you think that you can just come in here and get rich quick, or that every trader makes a lot of money, that's just not how it is. That's not the truth. And if you don't believe me, just do your research. You'll see it. In the beginning, some people will have big gains who are fairly new to the game. They'll come in, make a couple trades, make a lot of money, think that they're the top dog, and then 2-3 months go by and they lose all the money that they gain. The reason is because they never developed the proper risk management, the right mindset of trading. And if you expect big gains with every single play, you will blow your accounts. Moving to investing is just long-term, evaluating the company, buying them at a comfortable price, and then knowing that you will make money with it in the next 1 to 5 years or 5 to 10 years, something that is long-term. Investing is fairly simple, if you ask me. It can be made complex when you get into, building out your own portfolio, hedging your account, looking at different ETFs versus singular stocks or bonds. And, it can get complicated, but the general idea is to buy and hold. No technical about it. You can kind of set it and forget it when it comes to the pros. Now, one of the cons when it comes to being a trader is the time commitment. It's more than just opening up your phone and looking at a few stocks and then buying something that's long term. Let's say if you like DraftKings or you like Apple or AMD or whatever that it is. It's not just opening up the app and saying, all right, I'm gonna buy it, click, 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 done, put my phone down. It's not that simple. I'm not gonna go through and make a whole list of like pros and cons. You can kind of just get an idea of what we talked about today in terms of what it takes to be a trader, what it takes to be an investor. And I'm not saying that it doesn't take intelligence to be an investor. Like I said, it's levels to it. There's levels to all of it. When you are an investor, you are looking at financial reports. You're looking at business aspect of what the company is, longevity, how long have they been a part of the stock market, are they getting delisted? There's a lot of different things that you have to pay attention to as an investor, but there's just no technical analysis to it, which makes it more accessible to those who don't know a whole bunch about the stock market, but are able to Google some stuff, look at the news, and then make a couple investments. The last thing I want to cover is the question that everyone wants to know, which is which one is most successful? Which one is best? Warren Buffett has an average of a 20% gain a year. And granted, he is the old-fashioned version when it comes to investing. So 20% a year, and the top day traders and swing traders make about 10% to 40% return a year. So when you compare them, yes, 10% is less. So some day traders aren't making as much. The really good traders are making double. You have lesser traders who may only make 5-6%, but you also have investors who may not even get to 20% a year. So there's levels to all of it. It's smart to just play your account. Whatever that you can invest. Whatever you can risk when it comes to trading. Just be smart. Make sure that if you are trading, you have a long-term account as well. Other than that, you are gambling. Long-term portfolio is the spine of your back. It's there to hold you up. So if you lose money, you're still gaining a percentage of return on your long-term portfolio. When it comes to trading, just remember, if you're going to trade, make sure you have a long-term portfolio. And if you're going to invest, make sure you do your research and you thoroughly look through and find the companies that you like. Not like them because someone else said they like them, but like them because you thought that that would be a great investment with your money. With that being said, if you're looking to start your investment journey today, click the link below where you can find our mentorship, money management, and stock investing group. This is where we work with you to develop a long-term portfolio and other stock trading techniques. Leave any questions below. Don't forget to hit the like button and subscribe to the channel, and I hope to see you soon with another video.